Welcome to Business Line's State of the Economy podcast, where you'll find insight, analysis, and the story behind the numbers.
So, welcome listeners to our monthly personal finance podcast from Business Line. I know a lot of you are actually interested in the national pension system, and the performance also has been quite splendid in the last 10 years. It has easily gotten us to a double-digit return if you are invested in the equity option of the scheme. So today we have with us Mr. Rahul Bhagat from DSP Pension Fund Managers, who is the CEO of that firm, to look into the hood of how the equity portion especially is managed and what is actually, how do you compare NPS to other retirement options and so on. So thank you, Rahul, for accepting and our invite to be part of this podcast. Let me get to my first question. So how does the national pension system compare to the 401k plans in the US? I mean, they've been a very long-standing product for retirement there.
Yeah. So thank you, Aarati, for giving me the opportunity to come and speak and meet the audiences and explain about NPS and how it is different. Thank you so much. Now coming to your question, both NPS and 401k are retirement vehicles. 401k is very prevalent in US and NPS was started in 2004 by the government of India. Now, if you look at, they have a lot of similarities and they have also a lot of differences. 401k is very, very popular in US. It is the investment basket is very, very wide. It gives you stocks, gives you index, it gives you mutual funds, it gives you lots of options, even REITs you can invest in.
Right.
So you have the investors have a lot of varieties when they're investing in. The basket is huge when they're investing in 401k. Now, compared to NPS, it's a product which is designed by Government of India. It's a very, very transparent, but it's a limited basket. It gives you asset classes which are equity, government bonds, and corporate bonds, and also in alternate assets, but that too with limitation of 5%. Equity, you can have a maximum exposure of 75%. And can you take too much of risk in equity? The answer is no, because you can only invest in large cap. That is BSE 200 stocks only. That's a restriction on the fund managers. You can't go beyond it. Whereas in 401k, you have a huge variety. You can choose mid cap, small cap, large cap. The choice is yours. When it comes to tax implications, NPS is highly tax efficient because you can save up to 10% of your basic salary by investing in NPS. Whereas in 401k, it's tax deferment. You maybe are investing today, but when you withdraw, you will have tax implications later on. So that's one of the major differences. Plus, there's also differences when it comes to withdrawal options. Withdrawal options are limited in NPS. In 401k, you can withdraw, but again, there are various regulations, various things kick in. Another major difference is in 401k, it's employer managed scheme, whereas NPS is government managed scheme of India, right? So there, the employer also matches the contribution up to 6% of your contribution. Means if you're contributing 6% of your salary into 401k, the maximum contribution employer will match is up to 6%. So different employers have different schemes, but that's the max limit. In India, we have government scheme where the government is matching the contribution, but in terms of private, it's purely your contribution. And whereas individual investing, again, it's a purely your contribution. Broadly, these are the difference between 401k and NPS. NPS as of today is not very popular, whereas 401k is very, very popular in the US. So broadly,
I know much of the assets currently managed by NPS are from the government part of it, right? A smaller portion is from the private sector employees investing on their own.
If you look at today, we ended the year 31st March at 11,73,000 crores of assets in NPS, of which only 2,17,000 crores would be of private. The rest everything is government sector. So huge, only 20% or less than 20% is private sector, rest is government sector. Yes, so you're right. When it comes to the contribution, major contribution has been done by government employees. Yes.
So that brings me to the next question. Actually, about 20 lakh crore of retail investor money is invested in mutual funds. So should people who are investing in mutual funds also invest in the NPS, and what can be the reason for doing this?
Yeah, a very good question and a very valid question. A lot of people have these complexities when they're looking at investment. See, mutual fund is an investment vehicle for long-term, short-term wealth creation, which is required for various financial goals, right? It could be for marriage, could be for your kids' education, it could be for retirement, it could be for, maybe your short-term vacation goals or buying a car, you're saving for that, right? Whereas NPS is purely a vehicle for retirement goal. So there are huge differences when both the products come in, and the investor should look at investment goals, risk tolerance, what is his time horizon, and what are the tax implications. Now, if I look at NPS purely, if you look at what is the investment goal, it is for retirement. Whereas mutual fund, it can be any. Then, if you look at risk tolerance, mutual funds, especially the equity side, you can take huge risk because you have small cap, mid cap, and large cap stocks to invest in. You can invest in various ETFs as well. Whereas in NPS, the investor has limited choice because as per the regulation, the fund managers can only take exposure into BSE 200 stocks only, where also they are choosy, and sometimes the fund managers have a concentrated investment philosophy because of which the exposure is very limited. So that's you need to consider what is the investment goal basis that. Now it comes to the risk tolerance. We're talking about the risk tolerance. So basis the risk tolerance, you decide whether you want to invest in mutual funds or you want to invest in NPS. Obviously, you also have options in the debt schemes, which is the government bonds and the corporate bonds, which both of them offer. Then we look at what is the time horizon you're looking at in investment. Retirement goals are purely long term in nature. It cannot be met in short term. So you can choose both mutual fund as well as NPS in case you have those goals. But if you look at the cost implications, what are the fund management charges? NPS definitely is a big winner because the charges are ranging from 0.9 paisa to 9 bips to 3 bips, whereas mutual funds, the average cost is very high as compared to investment in NPS. Because if you also look at investment in debt to equity, the charges will range from 25 bips to maybe up to 1.5 to 200 bips, 150 to 200 bips.
Yeah, in mutual funds.
In mutual funds, yes. So that's a huge difference. And then the biggest difference also comes to the tax implications. There are special tax advantages if you are planning to invest in NPS. One is you have section 80CD specifically for 50,000 investment for the retail investment. Then we have another tax benefit for employees who are where employers deduct from their salaries and invest in NPS. They can invest up to 10% of their basic salary into NPS with a cap of 7.5 lakhs, to which you can get the tax benefits. So that's a huge benefit which which mutual funds can't offer. So broadly, these are two different vehicles. Now, what's the purpose of the investor? Why they want to save that money? Basis they can choose whether they should choose an NPS or mutual fund. But if your goal is retirement, then it's definitely NPS stands out way ahead from any other investment vehicle for investments for your long-term retirement perspective.
Right. So the cost part, can I again clarify? You're saying 3 to 9 bips is the cost, is it, for NPS?
Yes.
Okay. Because I remember earlier the bidding used to be based on a standard fee, but I think now it has some differential fee has come in, right, between managers.
Yeah. Maximum you can charge is 9 bips, and as your assets grow, your charges automatically come down.
Okay. So one thing I've noticed about NPS is that even the corporate bond and the gilt portions actually tend to perform very well. even compared to mutual funds. So I guess the cost advantage really plays there, right? In terms
The
of
cost advantage and also the regular monitoring which is done by the regulator in terms of the asset class which you are picking. The regulation is very tight on how much exposure you can take in, group companies, which can't exceed beyond 15%, right? All of these, because we are highly regulated, it also puts a lot of control on us on on how much exposure we take. And the risk, if you look at it, is in the corporate bonds and equities. The government securities are very, very safe.
yeah.
And from that perspective, when we're investing in corporate bonds and equities, definitely the risk is limited because you're investing in top 200 stocks and not in mid caps or small caps. So it safeguards the investors, there. In terms of corporate bonds, again, there are rating limits, nothing less than AA we can invest in.
Okay.
So that also plays a huge safeguard from the risk perspective on where we invest in.
Is there any restriction on duration? I mean, duration is also a risk, right? So is there anything regulating the duration that you take or on the
No,
corporate?
there's no regulation in the duration. See, duration actually helps you manage your funds better, given the debt markets are very, very volatile these days, and interest rate scenarios also keep changing given the inflationary pressures we have today. So with that in mind, regulators have given leeway to the fund managers to take a duration call. And based on the market dynamics and their understanding of the debt market, they take that call so that they can give best returns to the investors.
Right. So since you're saying by regulation, you can only invest in the top 200 stocks, what kind of strategies do you actually follow in order to deliver alpha? Because we know that in the mutual fund industry, the fund managers have found it increasingly challenging the large cap fund managers to beat the index, right? So here, what do you really do to deliver some alpha to the investor?
See, our philosophy is there are various philosophies and various styles of investment, and every fund manager is unique in its approach. We are totally into value investing, and we have a very concentrated approach. If you look at a portfolio, it's not spread out. We would have exposure in 29 on 30 stocks out of 200, and that's a conscious call we have taken. We invest only in companies which have zero debt. Barring banks, we don't take any exposure into companies because, again, that eliminates the risk. Companies which have debt have a chance of a fallout when things go south and their business models fail. And we have seen, NBFCs in the past how they got impacted because of the huge debt. We have looked at the aviation sector. Some of the airlines went bust because of the huge debts there on the books. So we keep ourselves away from those companies, and we want only those companies which are debt free. Barring banks. Banks are in the business of lending, right? So there's anyways, but the banking system anyways is robust, and RBI is taking care of it. But we believe so. There are some sectors which are strong, which are growing. We believe in. So we have a very, very concentrated approach. And we believe in value investing. We'll always look at stocks which are undervalued, given the market situations. And as markets are increasing, we are almost at 75,000, 75,000 as Sensex. So it's very tough to do value investing, but we still keep doing that day in, day out. Different fund managers have different approach. Some of the fund managers just mirror the BSE 200 index so that they're safe, and it's more of a passive kind of strategy rather than active. But we as a fund manager, we want to create alpha. We want to beat the benchmark. We have taken an active call that we will be the active fund managers, and we would, over a period of long term, we will create alpha for our investors.
Yes,
without taking the less risk as possible, but generate alpha.
Right. That's good to know, because there is a perception that basically a lot of NPS equity managers are closet indexing and things like that. So I'm sure the focused approach plus this filters that you use should be helping to deliver alpha. The other doubt I have is earlier there used to be some churn in this NPS fund managers. Like every 3 years or so, the government used to call for a tender and people used to apply, and then you would see some changes. So it was difficult for the managers to build a long-term track record with that scenario. How is it now? I mean, has there been a change in the rules?
Yeah, so the bidding has gone out of the window. Now, as per the regulation, is on tap license where they have certain regulations and guidelines, and whoever meets those guidelines can actually come and apply for. And the fund management fee is fixed now. We can always look at going back to the regulator and saying that can you improve it, because we also it sometimes become challenging for us given the fund management is very, very low. But having said that, within that framework, if anybody fits in, can actually come and apply for license and stay. So there's no now renewal of licenses, which was earlier 5 years. It's a perpetual on-tap license. As long as you meet the fit and proper guidelines of the regulator, you are in the business of doing it. That gives you the longevity to run the business, that gives you the confidence on the regulation side. That also investors can, have this confidence that you are for the long term. So the fund manager can also showcase their performance, because pension funds are for long term, they're not for short term. You need patience, and you need to take calls which are long term in nature and not short term. In a way, the fund managers don't have the pressure like mutual funds, where we are under tremendous pressure to show performance month on month, quarter on quarter. If we believe in certain sectors and certain kinds of industry and certain businesses, we can obviously take some calls which are long term, and it helps us because the duration for pension funds is very, very long term and not short term.
Right. Yeah, so that was one thing I wanted to ask also. In this open-end fund structure with mutual funds, people are constantly coming in and out, and we also have issues like a lot of inflows coming in when the markets are high or when past returns are good. In NPS, the flows are more steady and investors are locked in for the long term. So how does that actually add to, does that help you actually manage the fund in a better way?
Yes. See, again, a very good question, and it's very, very relevant. As I was talking about earlier, that pension funds are long term, and the money is sticky in nature, whatever comes to us. We know that money is coming. Plus, we also have visibility on our outflow, which is due from retirement's perspective, right? So then when a fund manager is investing, he knows he has the durations of those investments. They can take the duration call and they can invest for long term. That really helps us in order to perform better and also take investments for long term and help us pick the right kinds of businesses which we know will do better over long term, if not definitely short term. And we can then take some conscious call to invest in such businesses with the confidence that this money is going to stay and will not churn as frequent as it churns with mutual fund companies.
Right. So you come also from a distribution background in ICICI Prudential, I was seeing. So what are the barriers you face when you try to actually pitch NPS as a product to investors? I mean, I know you don't do the pitching, but what are some of the barriers that you see from the investor side, which is making the NPS grow very slowly actually on the private side?
Yeah. So the biggest barrier is the longevity. People are really afraid to commit investing in a long-term fund where they know there are barriers to withdraw. There are options where they can withdraw, but like we can withdraw in our provident fund, similar way we can withdraw from the NPS. We'll maybe talk about it some other day. A lot of people also don't know how they can withdraw money from NPS, but there are some barriers. But given those barriers, still you can withdraw money. So that's the biggest challenge which I think we all faced when you're looking at voluntary money from the private sector to commit for long term, because today, especially the young generation, they feel that they don't realize the importance of pension. and they're always looking at buying some gadgets and spend some money, do vacations, which
Yeah.
gives them maybe short-term benefits or some happiness. And by the time, people turn 35, they're married, they have kids, that is when they realize the import of a pension, and that is when they start thinking.
Right.
So we actually did a survey sometime back in my previous company, and we're looking at what is the age when it triggers. And 35
Mm.
is the age where
Mm.
people start thinking about, 35 to 38 is the age when people start thinking about pension. And that is where, I feel it's already late.
Yeah.
Because timing in the market and the compounding really
Mm.
plays out if you start early. And the more you delay, you've missed the bus.
Yeah.
And then, if you start early, you have to even small savings will grow bigger because of the compounding impact. Whereas if you start late, then we'll have to contribute a lot more to catch up, and it's very difficult to catch up. So that's
Yeah.
one object. Other thing is, taxation is great. So from taxation aspect, I don't think there was some issue sometime back, but now that's sorted.
Mm.
And what I've seen is the scheme is becoming better and better. Now, with the change in regulation, we also have systematic withdrawal plan where people can
Right.
withdraw it systematically. So the product has actually enhanced over a period of time. It's all about the other major challenges, education and awareness. So people are not aware about the benefits of NPS, how it's going to benefit them, what are the tax benefits. So what is required today also is we need all of us as an industry to go out and create awareness about the product, create awareness about the benefits, create awareness about retirement, why it is critical as a goal, and it's supreme than other goals at all. I mean, the priority of retirement goal has to be number one, and all other goals can have a, maybe number two, number three, number four.
Yeah.
And that is when people will realize they will uh, get into the fold of NPS or start to save for their retirement.
Right. Actually, I can completely relate to your point about the late start because whenever we write articles about retirement, also many investors say, I am now 40 years old and I'm starting on my retirement. Can you tell me what I should do now? And then,
Yeah,
I mean, when you do those calculations at 40, I mean, the amount you need to save, etc., becomes really, I mean, quite large and sort of unattainable, you know. So,
yeah.
yeah, so. At that point, you can't tell people, oh, you should have done it at 25 or something. But I hope in the next generation, at least, people sort of realize it and go with it. Yeah, yeah. Then when it comes to the features, yes, one put off is this long lock-in. Basically, I think NPS rules allow you to withdraw only 25% of your contributions until 60, right? That is the rule, right?
That is there, but you can now, the rules have changed, I think, sometime last year. You
Mm.
can also now exit after 5 years. Like you can exit in some of the insurance companies where you lock in is 5 years. So the
Mm.
regulator looked at it and said, if you really want money, you can exit the scheme after 5 years. But the thing is, that is where you can only withdraw 20% tax free, and the balance you have to buy pension.
Mm.
Whereas
Oh.
if you hold till retirement, you can
Mm.
actually withdraw 60% tax free, and 40%
Right.
is where you have to buy annuity, right?
By
So that's a
pension.
huge, huge benefit in terms of commuted value or
Right.
the cash value which comes to you. So
Right.
yes, the myth is people feel that you can't withdraw till 60, but no, you can actually
Uh,
withdraw complete withdrawal from the scheme after 5 years. And if you
mm,
feel that you want to enter again and start again, you can do it again. There's no
mm.
restriction.
Okay. Okay. Now, talking of that compulsory annuity part, that is also another thing which makes people hesitate. I mean, sometimes people in their 40s or 50s say, can I start with NPS? And you tell them it's a little bit late, but you have a 10-year horizon, maybe you could look at it and maybe with a higher C and G allocation perhaps. So, but the
Yeah.
thing is, for them also, this rule that at the end 40% has to compulsorily go into an annuity plan, that has been a slight discouraging factor. Is are there any indications that you're getting from the regulator, etc., that this could be relaxed? Because as you said, many of the features of NPS have become more and more friendly over the years. So,
Hmm. See, as of today, we don't have any indication from the regulator that this will go away, but uh, you never know what happened in the future, right? If you look at the Western world, even annuities, people don't take annuities. People are just invested in their pension schemes, and they do systematic withdrawal from the pension schemes over a long period of time. Like it's
Right.
like a annuity which is invested in market. It comes with its own risk. So are we prepared for that today? The answer is no. As the markets mature, as people get more confidence in equity markets and they understand it better, we might take that route. But today, I don't think we are currently prepared to take that route. But yes, that's an option. That happens in the Western countries. I think we also move. I can see, maybe I don't know the timing when, but I can see we also might move in that direction. But
Right.
other thing is a lot of people just say today that the annuity rates are bad and it's lower. But if you get it logged in today, I remember having these discussion because in my previous organization, I was also responsible for annuity business along with NPS.
Mm.
I used to sell annuities and have roadshows and with central government,
Right.
state government. A lot of people when they were retiring, the annuity rate was around 9.5, maybe 10%. And they were saying this is low given the markets are high. But now if I look back, after 3-4 years, that
Yeah.
rate is phenomenal. Means
Really
it's like
good.
it's really good. So
Yeah.
and I tell them annuity is nothing but a fixed deposit for life.
Correct.
And there's no other product which can beat annuity product. So maybe short term we feel the rates are not good, but imagine you will get this because the rates get locked in for annuity.
Lifelong. Lifelong.
It's
Right.
lifelong. If you live till 100 years, you will get
Yeah.
same return till the
Yes.
time you're alive. And it's
Right.
not easy for anybody to price that. It's a very, very
Correct.
risky business. And if you don't price it, in fact, most of the insurance companies have gone bust where they have gone wrong with pricing annuity business. I'm not saying that will happen in India. India is not going to go through that phase ever, hopefully. But it is so difficult to price. And if somebody has given you a price, they have thought about the longevity risk, the reinvestment
Right.
risk, and all other risk, and then they have priced it. So
Right.
it's not that bad a product where and how people make it so.
I understand. Yeah, I get that. I mean, I remember in the previous generation, there are people who retired and put their entire retirement benefits into FDs. And then the rates have fallen so much that there is so much of reinvestment risk. You keep getting a lower and lower income from the same corpus. I mean,
Yeah,
annuity basically protects you from that kind of a situation, right?
absolutely.
Yeah.
Absolutely.
The last question is basically that people are very much aware of the government part of the NPS and also the private part where I can voluntarily invest in the NPS. But there is
Yeah,
also a corporate NPS, right? Where
yeah.
certain employers offer NPS as a product to their employees, just like the EPF. Can you talk a little bit about that?
Yes. That's again a very good discussion point because a lot of people are not aware.
Yeah.
Uh, if you're employed, you can actually reach out to your employer and say you want to contribute into corporate NPS scheme. What it means is uh, corporate is going to make a deduction from your CTC and show as a contribution being paid by the employer on your behalf. Uh, so your take home comes down. But the good part is you get a huge tax benefit, and the tax benefit is up to 10% of your basic salary.
Mm.
And this is unique to NPS. No other
Mm.
product can offer that tax benefit. So it means suppose you are on and when they say 10% of your basic salary, not the CTC.
Yeah.
So
Yeah.
example, if you're in a tax salary bracket of 20 lakhs and your basic is, for example, say 6 lakhs,
Mm.
60,000 out of that can straight away save you
Mm.
tax. And as the salary goes up higher and higher, this savings can be and the contribution limit, which is capped at 7.5 lakhs.
Okay.
But again, you reach that level when you are maybe your salary
I know
is
it's a very high level. Yeah.
very high level. So
Mm.
I think 95% of the employees can take benefit in
Mm.
under the cap of 7.5 lakhs. Very few senior people will have a limitation because whatever the contribution goes, it cannot go beyond 7.5 lakhs. So, and the good part is it happens systematically. It's a monthly deduction which can happen from
Mm.
your salary. And the good feature is it is up to 10%. It not
Mm.
says that that it has to be 10%. So you can choose whether you want to contribute 1%, 5%, 8%, or 10%, or any amount also. You can specify, you can ask the employer, can you deduct, okay, 20,000 rupees per month from my salary and show as an employer contribution into NPS. Now, that's a big advantage because systematically the money is getting deducted, you're getting tax benefits. And another important part in NPS is since you have 4 asset classes, in case of switching between the asset classes, there are no taxation.
Correct.
Today you are in equity, you want to switch to debt, you can do without any taxation. From equity in debt, you want to switch back to equity or spread your risk, you can do it. Again, there's no taxation. So as long as you're in NPS, you can switch between the asset classes because these are synthetic funds and you can change your asset allocation the way you like it without any tax implications. So that's a huge plus, which I forgot to mention earlier. So that's another benefit for. And when you retire, you can take lump sum, 60% of the lump sum as cash in hand, and by 40% you buy pension. If you want to have a higher pension, you can buy pension for 40%, 60%, 80%, or 100% if a corporate. The choice is yours.
Right. So is this corporate NPS available in all organizations or only in selective ones?
So it's become very prevalent now. Earlier it was not. But in case it's not there, it's a very easy process. It's a very simple process where a corporate registers along with the POP, which is the distributor and the CRA, and can even start for 1 employee, 2 employees. There's no minimum requirement of 10 employees or 5 employees. Even they can make a contribution for 1 employee. So from administrative point of view, they just have to become part of NPS and do the deduction. Nothing else. All the responsibility, the investment risk, all the responsibility lies with the employee. There's no obligation from the employer side other than the deduction.
So part of the CTC will be going towards this NPS contribution. That's how it is, right?
Yes. Up to 10% of your CTC can be contributed with a max cap of 7.5 lakhs. And if you're in your individual capacity investing 50,000, you also get tax benefit on that as well. So you have 10% of basic plus 50,000 under section 80CD1B. Collectively, you can save tax on both.
Right. Yeah, that's very interesting to know. So does this happen in addition to the EPF contribution usually?
Yes.
Because EPF is compulsory now.
Yeah, so you can save money in EPF, you can save money in NPS through employer, you can save tax on the contribution made by you up to 50,000 rupees by yourself. So these are the 3 windows where you can invest in. And section 80CCD1B and section 80CCD2B. So these are specific for investments into NPS, specific to tax saving.
Okay, those were my questions. Is there anything you would like to add, Rahul, as a final summary?
So I think we have covered a vast subject on NPS and how it is different from mutual funds. What I want to say to the listeners and investors is, if you're not considered NPS, it is definitely one of the best products available in the market, given the tax advantage, given the cost advantage, and given that it's not a very high risk product. Even in equities, it is the lowest risk because it's investing in large cap companies only. Though equity are risky, but within that risk also it is the least risk among the equity. So consider that it's a beautiful product, simple product, and if you need any help, we are there to serve you at DSP.
Thank you, Rahul. In future also, if you have any doubts about NPS, I'll reach out to you for clarifications. Thank you so much.
Definitely. Thank you for having me. Thank you so much.